Hey guys, welcome to my video on stagflation and monetary policy. You might be wondering, what is stagflation? Stagflation is the combination of high unemployment and high inflation. It doesn't happen very often, at least not in the United States, but that's two bad things happening at once, where usually we only see one or the other happening. So it makes us sad. Our economy doesn't like stagflation. Stagflation usually comes from a negative supply shock. I say usually because there's probably some outside circumstance. Plus, it doesn't happen all that often here. Like, we didn't even know this existed until the 70s, and there haven't been any major examples of it since then. Anyway, negative supply shock just means your short-run aggregate supply curve is falling. So, what does this look like? Here's an economy in equilibrium. Short-run aggregate supply decreases. There's the new one. And there's the new GDP, which is there. GDP had fallen, which means production fell, which means our unemployment rose during this change. At the same time, our new price level is higher than our old price level. And that means that there's been inflation. And in this particular case, it can also take a long time for the economy to self-adjust because it's the supply curve that's out of sorts anyway. So this is an unpleasant thing. People aren't working and prices are rising on them. The classic case, as I mentioned, is the oil embargo from the OPEC nations. The oil producers, mostly in the Middle East, united to raise the price on their oil. We called it an oil crisis because we used oil to move like everything around. All of our transportation, all of our ways of transporting goods, everything ran on oil. Still does, but not as much as it used to. When they raised that price, it rocked our economy and put us into the stagflation. How bad was it in the 1970s? Our inflation rate in the early 80s got as high as 14%. And our unemployment rate was about 8%. That's two bad numbers for the United States. Now, the challenge with this is there's a dilemma. The Federal Reserve has a dual mandate of keeping inflation low and keeping unemployment low, but that dual mandate mixed with stagflation means we have a dilemma, a tough decision to make. Because we can either try to decrease the unemployment rate, which I'll draw on this side, or we can try to fight inflation and lower prices, which I'll draw on this side. And you'll see that whichever problem I try to fix, I'm going to make the other one worse. Notice I didn't draw the whole short-run aggregate supply curve shifting. I'm just assuming we're on SRAS2 right now. I can try to decrease unemployment rate with expansionary policy that raises aggregate demand, increasing GDP, lowering unemployment, but also raising the price level. So if I lower the unemployment, prices will rise, which creates more inflation. And we're already at 14%. Or I can go on this right-hand side and try to lower the prices. What if I tried to get the price level back to where the LRAS curve meets the AD curve? Just to get to where it was before the oil crisis. Well, I could lower my aggregate demand with contractionary policy. And the price level will fall. There it is. And it's comparable to the original price level. So I've fixed the inflation problem. And maybe even, I guess the way I drew it, I undid the inflation that had happened. A little bit of deflation, but whatever. But the problem with doing it is GDP will fall further, creating even more unemployment. So we can't fix both. We have to choose one or the other. That word dilemma, I mean it. We have to choose one or the other, and whichever one we fix, we will make the other one worse. I guess we could just choose not to do anything, but that's not usually what we do. Anyway, the Fed chose to stabilize prices. Paul Volcker was the chairman of the Fed, and he doubled down on stabilizing the inflation, and he just let whatever needed to happen to the unemployment rate happen. So inflation went from 14% down to about 2%. These are rounded numbers, they're not perfect. Unemployment rate went from 8% to 11%. We fixed prices. We got back to stable prices. But we made the recession worse in doing it. There's the dilemma. If we had fixed the recession, inflation would have gotten even worse. And that is the big trade-off. So, it's kind of a short, simple video. Stagflation comes from negative supply shocks, and it sucks because, one, it creates an uncomfortable scenario for us where we have high inflation and high unemployment, and two, it creates this nasty policy dilemma where we're not quite sure how to fix the economy because whatever problem we do fix will make a different one worse. Anyway, I hope it's helpful to you to see it all in one short video. If not, too bad, but thanks for watching anyway. You guys, I'll see you later. Happy econing.